Hello, I'm Bernard Hickey from interest.co.nz and welcome to a special housing and investment report. Today we're going to look at the grief that's going on in the property investment sector, in particular residential property investment and the resort sector in the South Island, where today there's another victim. The Canterbury Mortgage Trust has just announced that it's frozen withdrawals from its $250 million fund. Now it, in theory, lends out money in first mortgages, bridging finance, to people who are buying houses. But it turns out a large chunk of that money was to property developers and investors, particularly in the Canterbury region and in other parts of the South Island. About $60 million worth of investments will now not be paid out between now and October. The Mortgage Trust says it's frozen those withdrawals and will make an interest payment in October. There's about 5,000 investors, mostly from Canterbury, in the Canterbury Mortgage Trust, and this is really important for the whole mortgage trust sector. It turns out that over half of the trust's money was lent to property investors and developers, about $26 million in apartments and $56 million into residential developments. Turns out too that over $54 million worth of those loans were past their due dates. So that means people hadn't been paying the interest on them or hadn't repaid them on time. That's 21% of all their loans are either past due or were judged to be impaired. And that's because of this fallout in the property market from a collapse in prices. Basic problem for Canterbury Mortgage Trust was one that many banks share. They borrowed short and lent long. So all of their $266 million that was invested in the Canterbury Mortgage Trust could have been pulled out at 90 days notice. And the theory was they were lending out loans that were short-term bridge loans that could be retrieved in a hurry to pay out people as they withdrew their money. But it turns out that a good chunk of the loans, about $160 million worth, were due to mature between 6 months and 5 years. And 6 of those loans make up 22% of the book, about $53 million. Bit of a coincidence perhaps that $50 million are past their due date, $50 million are out in the 6 biggest loans, and $50 million is the number that are impaired. So this shows that the property investment market is in deep trouble, that the mortgage trusts and the finance companies who are exposed to it are also being hit by the fallout from that, and many investors who have invested in mortgage trusts must now be wondering how much of their money is stuck in failed property developments where the volumes are simply not being done to extract the money from those developments. I'm Bernard Hickey. That was a special report for interest.co.nz.